Good afternoon, everybody. It's really a pleasure to welcome you to this session. We have two very interesting papers on CCYB and around CCYB and positive neutral. But before I pass the floor to Javier, let me thank the organizers for your kind invitation. It's really an honor and a pleasure to be here. Rafa and myself, under Governor Linde, we organized the first conference, and like a father that is very happy that seeing growing the children, I'm really very happy to see how this conference has evolved, grown, and I'm really very proud of what we started 8 years ago. And of course, thank you very much, Rafa and the CENFI, for the support, which is key for this conference. With any further comments, the floor is yours, Javier. You have 25 minutes, 10 minutes for the discussion, and you will have 5 minutes to grill the presenter. Thank you very much.
Okay, good afternoon, everybody. I will present the paper, Simple Implementable Financial Policy Rule, a joint work with Mauricio Calani, also for the Central Bank of Chile, and Marco Piña, PhD student in the University of Virginia. First of all, let me start with the motivation of this paper. In this paper, we study the countercyclical capital buffer, the CCYB, from the point of view of the policymaker. And the question is why this is important. Because as you can see in the graph, we show a panel for the level of the CCYB for different countries. There are a clear pattern that, or better, there is no a clear pattern regarding when and how much we have to increase the level of the CCYB, and also what is the neutral level for this new macroprudential policy. However, there are some theoretical studies and also macro banking models, as your paper, Manuel, who study these issues. So in this research, we're going to try to answer two main questions. The first one is how should the implementable financial policy rule looks like? And the second one, if there are any space for a neutral level of the CCYB. But before that, what do we know in terms of the literature regarding this topic? We can split in three different subjects. The first one is that macroprudential policies can smooth the credit cycle, and also the macroprudential policy can act as a mitigator of the systemic risks. And also there are some papers who give us some guidelines regarding the design of the CCYB. And what do we learn about this study? If we want to study this problem from a macro modeling point of view, we have to include two main frictions or two main features in the model. The first one is that we have to include financial friction in the intermediation problems in terms of the limited liability or deposit insurance, because these generate an excessive leverage in the banks that justifies a steady capital requirement. And also, we have to include a dynamic social externality in line with the paper from Helver, for example, that generates overinvestment during the bonds. So this justifies a dynamic capital requirement in the economy. So what do we do in this paper? First, we build an estimated GSG model with a prominent banking sector. Specifically, which is the model is thinking for the Chilean economy, is a small open economy new Keynesian model. With intermediation problems, we will have savers, bank, and borrowers. And in terms of the financial frictions, we have incomplete markets, specifically costly state verification, a la BGG, deposit insurance, and limited liability. And one important thing, or more interesting thing of our paper, is that we take into account the occasionally boundary constraint in the design of the CCYB. Then, with this model, we consider different financial policy, and specifically simple implementable financial policy, and we will evaluate it with the consumption equivalence. Last but not least, we explore different implications of put a neutral level of the CCYB. So our main findings are two. The first one, and in line with your paper, Manuel, and also other study, that a price-responsive roof generates higher welfare gains rather than other policies that follows quantities. And secondly, it's welfare optimal to have a positive level of the neutral CCYB. Okay, let me go directly to the model, and I'm gonna explain the model with two main blocks. The first block in the model, the blue box, is the typical neo-Keynesian model with nominal rigidities, sticky prices, and so on. But the most important thing in the model is the green blocks. The green blocks is the financial blocks. In this block, we have savers, patient household, unrestricted, in terms of what kind of asset they can save. These savers lend money to the banks in terms of the deposit and long-term bonds. And then these banks lend money to the impatient household and also the entrepreneurs who need money to buy capital and the impatient household to buy houses. Sorry. Oh, oops. Let me go back. And obviously, because this is a small open economy, we have an external sector, a government who implement a deposit insurance, and monetary policy, and principally a financial policy. Okay. In terms of the policies of the model, the monetary policy follows a typical Taylor rule with GDP gap. And one of our main contribution in the paper is propose a financial policy, a kind of Taylor policy. As you can see, the CCYB follows the expression that you can show that governs the inertia of the CCYB by the parameters θ1. This reflects how fast we can move the CCYB. And the financial policy will react to change and for a variable xt. Also, how fast and in what direction the CCYB will react in terms of the change in xt will govern by the parameter θ2. And also, we allowed some forward-looking degree in the policy. Then, the CCYB that comes from this financial policy will affect the capital requirement in the model, also for the commercial banks and the mortgages bank, and obviously this will affect the balance sheet of the banks. Okay, now let me go directly to the results in order to the time. But before that, since we are using a general equilibrium model, it's straightforward to define the welfare in the economy. And we will define the welfare as the weighted discounted flow, the utility, and it will depend for the parameter θ that try to reflect what is the financial policy behind the model and the parameters of this financial policy, and also if we put some CCYB neutral in the economy. In this line, we also can define the baseline welfare, which is the perpetuity in the stochastic steady state of the economy, without any policy and without a neutral CCYB. Then, with these two objects defined, we simulate the model using perturbation techniques with second-order approximation and pruning also to find the consumption equivalence. And what is the consumption equivalence? Is the weight in the consumption of the baseline welfare that have to increase or decrease in order to equate the welfare that we obtain for a configuration of the economy, for different policies and different levels of the CCYB. So in a nutshell, is the consumption equivalent is positive, it implies that we have welfare gains for the certain configuration or certain financial policy. Okay, but now let me explain a little bit about the simple and implementable. Why this is simple and implementable? Because we only take into account X variable that we can observe. For example, the commercial spread, as in the paper from Carrillo, and also in your paper, I think you use the same, credit to GDP gap, which is the baseline guidance for the BIS, overall spread, which is the mean between the mortgages and the commercial spread, funding premium, and also we take into account some quantities rule, which is how fast growth the total credit and also the commercial credits. So in our exercise, we will keep fix the θ1, which is the inertia of the CCYB, that we assume that the CCYB will have a mean life of 4 quarters, And we're going to find what is the parameter of theta 2 in real variables that maximize the welfare of the consumption equivalence of the rules. And also we allow 3 difference of level of forward-looking degree in the financial policy. Now, this is our first result of our model. First, let me explain a little bit the graph. In the horizontal x, you have the value of the theta 2, which is the degree in which the financial policy will react. And in the vertical axis, you can find the consumption equivalence in percentage. So the first message that we can abstract for this figure is that the price responsive rule generates higher welfare gains, almost 3 times higher, for example, for a spread RL or a spread RB, which is the overall spread, is 3 times higher rather than the credit to GDP gap, which is the baseline guidance for the BIS. And also, you can see that for these 2 observables variables, there are not a clear gain for using different forward-looking degree. However, for the spread RD, there are some difference between the level of the forward-looking degree, but later on in the presentation, I will go deeply in this term. Now, but let me go back. We're going to put the emphasis in the maximum of each graph. But remember that behind that, there are 2,000 simulations, or n equal to a big number that we calculate, that we use to calculate the consumption equivalence. So this graph represents the histogram of the simulation of the CCYB in the maximum value of each figure. And the red dot lines represent the feasible band. Because remember, the CCYB can only live between 0 until 250 basis points. And as you can see, more than half of the time, if we don't take into account this feasible band, the CCYB live outside this region. So it's clear that we have to implement some filter pass band for the CCYB, or try to evaluate some non-linearity in terms of the, for example, the 0 lower bound for this new macropotential policy. So how we do implement this effective band? With a quadratic filter. What is the quadratic filter? It's a quadratic function that we evaluate the results that come from the financial policy, and then we find the parameters A, B, and C who minimize the error function. What is the error function? It's the difference between the quadratic filter and the real value that we want that the CCYB take. For example, if the CCYB filter take 300 basis points, the maximum value is 250, so the difference between both quantities is the error in the approximation. However, if we are in the feasible band, we want that the CCYB filter take the same value of the rule, so this is the difference or the error in the error function. And finally, the minimum value that the CCYB can take is 0. All variables below 0 is the error of the approximation. So finally, in the model, the CCYB that will apply is the quadratic filter of the CCYB. That's come from the rule. It had to be said that this algorithm is applied for each rule, for each parameter, and for each configuration of the economy. So, okay, here we can see the results of applying these techniques to avoid the occasionally boundary constraints. Obviously, behind that, we try to approximate a sigmoid function with a quadratic function. So therefore, it's not a perfect approximation of the effective band, but increase a lot the accuracy in terms of the how is the mass or what amount of the mass of the CCYB lives in the feasible band. So we can avoid the bias of the result of the consumption equivalence that I showed you before. So this table summarizes all the exercise that I told you so far. Here, in the bottom, in the top of the table, you can see the consumption equivalence without effective ban, which is the maximum value of the 3 lines color that I showed you before. And then we show the consumption equivalence with effective ban for different degrees of forward-looking degree. And the first message is, if we apply the effective ban, obviously the consumption equivalence reduces. This is because now the CCYB cannot take negative values, and we have this zero lower bound, and therefore the maximum welfare gains decrease. And also, we still have that the rules that follow prices generates higher welfare gains rather than policies that follows quantities. For example, spread RL or spread RB is almost 3 times higher than the credit to GDP, and also is higher than spread RD or the growth of the different credits. And one interesting thing about this policy is that the rules follow or inherit the characteristic of the observable. What does it mean? For example, for spread RL or spread RB, the banks in the model can react very quickly in order to change the variable or the value of this spread. And on the other hand, the spread RD follows very closely the monetary policy rate. So because we are using an initial model, we have sticky prices. So the higher welfare gains that we obtain is when we have a forward-looking degree for spread RD. In contrast, spread RL and spread RB, the higher welfare gain comes from the zero forward-looking degree. Okay. Now, in the last minute that I have, let me show you the exercise for the positive level of neutral CCYB. But before that, let me explain the intuition behind that. Remember that our model is a very big model, but the main friction in terms of the financial friction is a costly state verification. So follow the BGG paper. The external financial premium plays a key role in order to understand the channel and the amplification in the model. So the supply of the credits will depend positively in terms of the minimum capital requirement, and also with the level of the shock in the economy. And the demand for capital is typically the expression that you can see. But now, what happens if we hit the economy with a financial shock? If we hit the economy, the probability of default of the entrepreneurs or the household mortgages will increase, and therefore increase the external financial premium. And in the new equilibrium, the amount of capital in the economy is lower, and therefore the amount of credit in the economy is lower. But because we don't have any neutral, this is the new equilibrium in the economy. On the other hand, if we put some neutral CCYB in the economy, without shock, we know that the capital in the economy is less, because we have a higher capital requirement, so a less amount of credit in the economy. But now, if we hit the economy with the same shock, the old channels stay the same, but the quantity, or how the contraction of how is the contraction of this supply curve is lower rather than the case without neutral CCYB. But more important, now we have the ability to release the value of the CCYB. And so therefore, we can move the red line to the green line. So in a nutshell, what is the trade-off behind the neutral CCYB in our model is that in the steady state, we will have less credits in the economy, but on the other hand, we have the ability to react to shocks in the steady state. Obviously, all of these analyses don't take into account the general equilibrium effect and also the dynamic of the economy, but now in the exercise, it will. So what we do in terms of the calibration of the CCYB, we repeat the consumption equivalence strategy. We increase the level of the minimal capital requirement, but we shift the filter. We shift the filter in terms of the level of the neutral CCYB. For example, if now we have 100 basis points of neutral CCYB, the maximum value that we can increase is 150. Now to 250 because we already have 100 basis points. And on the other hand, the minimum value that we can take is minus CCYB, minus 100 basis points. So we can shift the feasible band of the CCYB. So now this is the main result regarding the neutral CCYB. In this graph, in the horizontal axis, you can find the level of the neutral CCYB, and the vertical axis, you can find the consumption equivalence. All the rules take the optimum value that we find before in the previous exercise. And first, we can see that this trade-off exists. And how we gonna realize its behavior? Because the concavity of the function. So therefore, the concavity, we can find an optimal level of the neutral CCYB in terms of the welfare. In addition, for all financial policies, the neutral CCYB increase the welfare, and we still have that the financial policies who react to prices generate higher welfare gains rather than financial policies who react to quantities. However, all the results that I showed you so far are assuming that we are in the optimal static capital requirement. So what happens if we move from this optimal level of minimal capital requirement? We obtain the following figures. In the left-hand side, you can find 100 basis points below the optimal minimum capital requirement, or the static capital requirement. And the left-hand side, the right-hand side, you can find 100 basis points higher than the optimal minimal capital requirement. So, in a nutshell, what do we find is the same mechanisms still have, but the quantitative results are different. So how we can explain this? Because remember, in this case, when we have the optimal minimal capital requirement, the higher welfare gain is roughly 2%. But if we put less capital as a minimum capital requirement, the maximum consumption equivalence is a little bit more than 3%. And on the other hand, totally the opposite for a higher minimal capital requirement. So how we can explain this? Because if we are in the left-hand side for the, this is the stochastic steady state for the welfare for different value of the minimal capital requirement. And if we are on the left of the optimal, the gains that come from the neutral CCYB is not only for the ability to release in bad times, but only because in the steady state we need more capital. On the other hand, if we put more capital in the economy, we have too much capital in the steady state. So, in a nutshell, the two main messages is that price responses rule generate higher welfare gains rather than rules that follow quantities. And it's welfare optimal to have a positive level of neutral CCYB that it's explained because the CCYB has a zero lower bound or effective bound, and also the optimal level of the neutral CCYB depends critically of how is the minimal capital requirement. Thank you very much.
Thank you very much, Javier. Remarkably perfect timing. So let me see if I'm able to find the next presentation. Is this one? So Manuel, the floor is yours, and you have 10 minutes, please.
Can we make them bigger, the slides? Control L.
Control?
Control L, I think.
Yes.
Yeah, thank you. Yeah, okay. So first of all, thanks a lot to the organizers for the invitation. It's a pleasure to be here. Last year, I discussed Giorgia's paper at the ECB conference. Very happy to discuss Javier's paper here today. First of all, let me say that I have that I think it's a very nice paper. I have a lot of questions, but I had to select just 5 in the interest of time. So please allow me to skip the summary of the paper. I'm just gonna briefly motivate my discussion, and I will quickly jump into the questions I have for the authors. So first of all, let me begin by saying that there's a broad consensus based on both evidence and theory that competent authorities should release releasable capital buffers in extraordinary crisis times. However, in recent times, in recent years, there's been an intense debate on when and how should these capital buffers be built. As you know, the Basel III Accords gave birth to the CCYB in 2016, and the idea was that credit to GDP caps should be used as a key common reference for the guidance of these capital buffers. Now, there's recent empirical studies, including the one by Bedallo and Calani, which clearly show that when banks have headroom for building these capital buffers, it is not only that there's no negative and significant impact on short-term lending, but actually lending can increase at longer horizons through a strengthening in banks' resilience. Now, in this regard, I would like to highlight that in the recent tightening cycle, there's been an increasing number of competent authorities that haven't started to build this capital buffer as net interest margins were increasing. And despite the fact credit gaps were in negative territory and these monetary policy shocks and other contractionary shocks were exerting a downward pressure on aggregate demand. Now, what does the theory say about this? So, Javier's model belongs to a general class of quantitative macro banking models that give that provide a reasonable and good rationale for prudential bank capital regulation by allowing for bank risk failure with idiosyncratic asset return shocks, limited liability, and deposit insurance. Now, a common result in many of these papers is that optimal static capital requirements are very hard to beat. There's very few exceptions, importantly the paper by David Duke 2017, that find that it's optimal to have cyclical capital requirements, but these respond optimally to macro indicators such as GDP and credit. In my recent paper by Muñoz Asmets, which I will be referring to, and apologies for being home biased, but I think it's going to be helpful in illustrating the comments I have here today, we saw that it's optimal to build these capital buffers when there is headroom for doing so, even if credit gaps are in negative territory. So moving into the questions, the first one is, how does the model speak to the evidence on the CYB I just mentioned? Well, if I interpret this figure, the first 2 panels of this figure correctly, my understanding is that the CYB should be accumulated when spreads are compressing, because I see that the value for theta 2 is negative, and when credit gaps are increasing, because I see a theta 2 being positive. This is basically opposed to what many national authorities did recently, but not only that, it goes against the intuition that, and the recent evidence that one should build the buffers when there's more headroom for doing so, meaning when bank profitability is going up. Now, the second quick question is, why do net interest margins enable the largest real and welfare effects for the CYB in this environment? Authors mention risk shocks. But my question is, what about the no default condition that is common in all these models, according to which the threshold below which bank defaults is fully determined by the bank capital requirement and by the components of the net interest margin? That is really the origin by which in these models it is optimal to build in response to net interest margins. But of course, typically, one additional channel or externality is needed to activate the entire full transmission mechanism, such that dynamic capital buffers are optimal in this environment, as I will explain in a bit. So what we do in our paper is basically to allow for two externalities. The first one, which is due to bank risk failure in this, and that I just explained, and the second one are basically, are pecuniary externalities due to collateral constraints in the real economy. Due to them, ultimately, there's mutually beneficial gains from trade between savers and borrowers, which can be exploited, and therefore the externality can be corrected by precisely building the capital buffer when the net interest margins are going up, because then savers are going to save more as the bank risk failure goes down, and borrowers are going to get more credit, and they're going to be able to consume more and invest more, and basically dynamic capital buffers are going to correct at the same time both externalities by managing bank resilience over the cycle. And basically, we saw that when shutting down these pecuniary externalities, the CCYB is ineffective or even counterproductive, and there's no welfare gains from this macro proof tool. Now, importantly, these models are particularly useful to talk about the transmission mechanism, right? However, the authors do not really talk about the transmission mechanism of the CCYB. But when talking about the transmission mechanism, they basically assume what happens in the face of an exogenous tightening in static capital requirements by assuming an exogenous shock to static capital requirements, but it's more about temporary effects of changes in static capital requirements. The story can be completely different, as the evidence says, and as we saw in our paper, if you really look at and distill the channels around the transmission mechanism of optimal dynamic capital requirements being built, in this case, in response to net interest margins. And finally, and I think this is very important because this talks about the entire analysis and discussion authors develop on the positive neutral. So how does the CCYB parameter interact with the other key policy parameters you have in your rule, meaning inertia or capital buffer smoothing parameter and the static capital requirement parameter? So first of all, in these models, there's complementarities between static capital requirements and dynamic capital buffers because both provide stability to the system through two very different mechanisms, but there's also a trade-off for the same reason between these two. Actually, we find that there's an effective lower bound for the bank default probability below which dynamic capital buffers are not effective. The transmission does not operate because you cannot reduce the bank default probability by accumulating this buffer because it's already very close to zero, and eventually you get welfare losses with dynamic capital buffers. I think you can kind of signal to something similar in your paper when you talk about the need of reducing static capital requirements in order to have a positive, neutral, and overall effective dynamic capital buffers. But I think you may want to elaborate more on what is behind these complementarities and behind this trade-off, and how you really want to calibrate the positive neutral. Because in these models, you may want to relate the neutral phase of the cycle to the concept of steady state. And therefore, the positive neutral may speak to the space you may have below the steady state or static capital requirements to be released. And you may find, as we do, apologies again, actually that with the optimal rule, which I'm not sure you compute by maximizing social welfare with respect to all these three policy parameters, which I think is crucial, also because inertia dramatically changes the trade-off between static and dynamic capital requirements, and you may end up finding that it's not really needed to apply the filter that you are using. I'm going to leave it here. Thanks a lot.
Thank you very much, Manuel. Perfect timing. So maybe before giving the opportunity to Javier to answer, I would like to open the floor to the audience for a few questions. And as I was expecting, Javier is the first one in addressing a question. So please, Javier, go ahead.
Thank you for the presentation. I'm familiar with these models, and I like to see them used also for small open economies, which implies enriching the model in very interesting dimensions. I had essentially two questions. The first is on, and is connected to something Manuel was saying in the discussion. It was unclear to me whether you eventually optimize simultaneously on the size of the capital requirement, the reference level, and the size of the CCYB, which would be like the releasable level. A connected question is, I think your results are probably confirming the perspective that you need sufficiently high level of capital requirements to be able to benefit from a release of the CCYB. If you were planning to releasing requirements when starting from low levels, that would be a problem. The last question is, one of the main results in your reading of the paper you presented is that price-based rules are much better than quantity-based rules, but I would like to have 2 sentences intuition for why. Thank you.
Javier, another question, please.
Thanks for the presentation. It's very connected to the last point that Javier was doing. So I was wondering, is it the price-based rules, are they more efficient because simply prices react faster, or to shocks, or is rather because their variance, if you simulate the model, is mostly explained by the shocks that you're trying to smooth out with the CCYB measure? Yeah, thank you.
Maybe time for a last question, please.
Yes, I'd like to make reference to the graph of the curves where you show the movement of the curve of the capital requirement and the releasable turning again to the right side. I'm thinking in that movements that you explained there, I suppose that they are based on the banks working without voluntary buffers, capital buffers, because usually banks have over and above the regulatory buffers, they have voluntary buffers, usually much larger than what would be the neutral positive CCYB. So in that case, the banks could use that voluntary buffer for a temporary stress period. And in that case, they don't need this neutral capital buffer to be in place. Additionally, the experience has shown in the last years that the banks are not making use of this space that releasing buffers gives them because of stigma issues, or just because they see that this release of buffers are temporary and they will reinstate very soon. So even that that movement that you mark with the green curve, maybe it's not will not be in the practice.
Thank you very much, Javier. Please, a couple of minutes to answer.
Okay. Thank you very much, Manuel, for your comments. Obviously, you are also very familiar with this topic. And let me say, first of all, about the externality behind the welfare gains that come from CCYB is because we have the same externality as in the paper from Alherbe 2020, which is the price of the credits. It's before the realization of the shock plus deposit insurance. Then the banks does not internalize the externality in the probability of default of the other banks. So then it's optimal, not optimal, it's welfare improvement to have welfare gains with the dynamic capital requirement. Also, we are totally agreed that we have to go deeply in terms of the mechanisms. We still working on, because we have some exercise where we are doing some exercise regarding the general impulse response in order to understand different conditions in terms of the different level of capital that we can understand the mechanisms. And I totally agree that we have to understand the trade-off between the change in the theta 1 and theta 2. We have some exercise, but in terms of the practical view, this is a conservative way, because we know, or probably the intuition, if we want to release, it would be very fast, but we want to accumulate, is slower. So then, because it's a symmetric movement, and then it could be even more difficult to solve computationally, we take this assumption. And regarding the Javier questions, for what, why the prices? Because the prices, and also related to your question, reflect very well the effect of financial shocks. This is the why the welfare gains come, and also because it's too fast. It's kind of both effect of your set, and yes, the voluntary buffer. Let me give you a caveat. We are currently extending the model in a similar way as your paper, Javier and Caterina, in the twin deficit, in order to have some compliance region in order to endogenize the voluntary capital buffer. So then we can understand how is the effect of the decision of release or decision to increase the CCYB, and what is the consequences in the credits, and also on the supply of credits. Yes, I think that.
Okay,
yeah.
Thank you very much, Javier. Of course, there will be plenty of time for you to bilaterally interact with anyone that is interested in further. Can you pass me, please? I'm really sorry, but I cannot resist to make a comment before passing the baton to Giorgia. It's, I mean, you Javier, you call this paper simple. The first word is simple. To me, and admittedly, I've been away from this world for more than 5 years, is everything but simple. Even the discussion. But I'm surprised that a very practical issue has not popped up in the discussion, or maybe I've not been able to understand it. For me, this positive neutral, I think it's a weird thing. It's a concept that you have developed, I don't know why, probably because the CCYB was not able to be activated at some point. But I'm sure that after listening to Giorgia, we may have time to discuss on these real problems and why we invent concepts sometimes to deal with other issues. Thank you.
Okay. Thank you very much. Let me see. Okay. Okay, so thank you very much to everyone to keep your presence here in the room. So first of all, I would like to thank a lot the organizers for including this paper in the program. It's a great pleasure to be here, and obviously also to be in Madrid. So this is a joint work with my co-authors Anna Pereira, Mara Pirovano, and Florian Stammwitz. We work in central banks, so the usual disclaimers apply. So the paper is called From Losses to Buffer, Calibrating the Positive Neutral CCYB Rate in the Euro area. So just a quick remark on the motivation. So to be everyone on the same page, what do we mean here by positive neutral CCYB? Essentially, we refer to the early build-up of the CCYB when cyclical risks are not yet elevated. And since as also was mentioned in the previous presentation, since the pandemic, an increasing number of EU jurisdictions have introduced a framework with a positive neutral rate for the CCYB. The main motivations that emerged for this new use of the CCYB essentially was mainly the desire of building up the CCYB in a timely manner in order to have a higher availability of releasable buffer, but also to increase the resilience against a wider spectrum of shocks going beyond those stemming from domestic cyclical risks. And finally, also to address a potential under-calibration of the CCYB, which can stem from mismeasurement of cyclical systemic risk. So despite this increasing use of the CCYB in this way, the quantitative methods to inform its calibration are still a lot under development, and what this paper do is essentially to contribute to this literature that aims to inform or to provide some quantitative framework to inform the calibration of the CCYB through the cycle, including with this positive neutral rate. So obviously we are not by any means the first one in providing some work for informing the CCYB calibration, so there is a lot of work based on risk indicators in the early days, then structural macroeconomic approaches like the work that we have just listened, and the work by, well, the work by Manuel with SMETS, and also there is all a strand of literature which includes stress testing and historical bank losses analysis, and this is where the paper sits. In particular, is very close to the work by Lange and Forletta and Passigna and Pereira, which essentially differ from, because while they focus on the calibration of the CCYB to address cyclical systemic risk, we include in the framework also, we integrate the calibration for the positive neutral rate. There are also some technical differences that we will see later on in the presentation. So what do we do in a nutshell? So the main idea is essentially to look at the historical bank losses and disentangle the impact of various factors on historical bank losses and then map those factors into the CCYB calibration. So we look at the impact of cyclical systemic risk, and we use this information to calibrate, to inform the calibration of the CCYB to address cyclical systemic risk, so when those are elevated. Then we look at the impact of unobserved systemic risk factors, and we use this information to calibrate the positive neutral rate for the CCYB. And at the same time, we control for a number of bank and country-specific risk factors that with the aim to mitigate or to minimize the overlap with other instruments. So with the idea that those bank and country-specific informations are mainly affecting the calibration of other micro and macroprudential capital requirements. So the ultimate goal of this work is essentially to provide a unified framework to calibrate the overall CCYB through the cycle, including when cyclical risks are not elevated. So a preview of the results, in case you will get too bored during the presentation and will not follow until the end, is essentially we provide a range for euro area calibration of the positive neutral CCYB, which goes from 1% to 1.8%, depending on policymaker preferences. And on this, I will be clearer in a second. Okay, so let's jump into the model. So our variable of interest is banks' return on assets, because we're interested in essentially looking mainly at banks' losses and profits. And if we look at this, the distribution of this variable across countries, banks, and time, on the left-hand side chart, what we see is that essentially the distribution has a clear strong left tail. If we look at this variable jointly with the DSRI, which is our composite indicator that we use throughout the paper in order to measure cyclical systemic risk, what we observe is that an increase in the SRI typically is not followed by any movement in the median of the distribution of banks' ROA, but it does follow an increase in the left tail of the distribution. So essentially the lower percentiles go down. Given this observation, what we thought is that using a model which focus on the median or the mean of the distribution was not informative enough, so we decided to use a quantile model. In particular, we use a quantile location scale model, and we combine it with local projection in order to have a view on the impact of the variable of interest at various horizons. So we model the conditional quantile of ROA as a function of the DSRI, as a measure of cyclical systemic risk, an interaction with the T1 ratio, with the idea in mind that essentially an increase in cyclical systemic risk hits the conditional distribution of the ROA differently depending on the capitalization of the banking system. We control for a number of bank level and country level factors, and we saturate the model with bank specific and time specific fixed effects. So the benefits of our frameworks, in our view, are just, first of all, that we can capture nonlinear responses of losses across percentiles. The local projection frameworks, as I said, allow us to study the impact of the variables of interest over different time horizons, including those that are more relevant for macroprudential policy making. It's a framework that is flexible to reflect different policymaker preferences, meaning that we can look at different severity of losses and decide which level of severity of losses we want to cover, and we just can do that by looking at different percentile of the distribution. So the more we go on the left, basically, the more conservative we are. And then, from a technical point of view, the quantile location scale model avoids incidental parameter problems and quantile crossing, which means that essentially we can include in the model bank fixed effects, which is not a trivial task in a quantile model. And we consider bank-specific fixed effect being an important element when studying banks' ROA. So I will be very quick on the data. So we use both country level and bank level data. We source them from SNL Financial. We have data from 2005 to 2019 at annual frequency. We include more or less 300 euro area banks at the highest level of consolidation, and which cover around 80% of total assets. So we consider this a representative sample. Just a quick note on the estimation procedure. Since our sample structure is such that we have a small t and a large n, the estimator that we use display a bias which is essentially increasing in the n to t ratio, and so we need to perform a split sample jackknife procedure in order to essentially correct the bias of the estimates. And what we do is that we take the bias corrected estimates and recenter the confidence interval around those estimates. So this is a procedure that is suggested in the paper which proposed the estimator that we use. It's actually a bit tricky, this, this mouse. Okay. So the result. So the figures here represent the marginal effect of a 1 unit increase in the DSRI on various percentile of the conditional distribution of ROA. So we can essentially see three main insights from these slides, from these results. So first of all is that an increase in cyclical systemic risk leads to a decrease in banks' ROA, which is so a negative and statistically significant impact on all the percentiles of the distribution that we are looking at, with a peak effect around the 4th years after the change in the SRI happened. This regardless of the percentile we look at. Moreover, we show a slightly stronger impact on the lower percentile of the distribution, but this is quite low, the difference. This is different compared to other studies which perform similar analysis, and with the main difference with these other papers that they do not include in the model bank-specific fixed effect, which we consider to be quite important, and we argue that this can be one of the reasons why differences across percentile are let's say, less strong and less prominent. One thing that is different across percentiles is the shape of the response. If we look at more extreme tails in the distribution, so if we look at the 5th and the 9th percentile of the distribution, what we see is that after the peak of the effects occurs, the 4th year, essentially there is a much stronger rebound at the top of the distribution, while in the bottom of the distribution the recovery is much slower. Like taken together, these results essentially suggest that the cumulated effect, so first the impact is negative across the distribution, and the cumulated effect of an increase in the SRI thus seems to be stronger in the lower part of the distribution. So now we use these results, this estimated impact, in order to calibrate the cyclical systemic risk, let's call it this way, so the CCYB to address cyclical systemic risk through a linear rule, which is displayed in equation 1. So essentially, we take the overall effect of the DSRI, which is given by the terms theta and nu, which is the impact, the marginal effect of DSRI and its interaction term. And what we do is to essentially normalize this for the average risk-weighted assets in each time and country, with obviously the idea to convert essentially these coefficients in terms of unit of CCYB as per required by the regulation, and we multiply this by the level of DSRI. So with this calibration rule, we obtain time-varying and country-varying coefficients that can vary depending also on the, obviously, percentile that we fit our model on. So here are just 4 examples of a country that we have in the sample. So we see in all the countries that we have seen, that we have here in the slides, obviously the suggested level of CCYB by the calibration rule is fairly high in the years previous the financial crisis, consistent with the fact that there was a high level of systemic risk in the system, while in the second part of the sample, in countries like in Austria and France, where in the post-sovereign debt crisis there was some more cyclical risk dynamics building up, we have a calibration rule which suggests an increase in cyclical in CCYB, while in other countries like Italy and Spain, where in the post-sovereign debt crisis, cyclical dynamics remain mostly muted, the calibration rule does not suggest any activation of the CCYB. Okay, so now we integrate the calibration for the positive neutral rate. So we have two main elements for the positive neutral rate that we want to achieve. So first is the target rate, which is the rate at which the positive neutral CCYB is set when in times where risks are not elevated. The goal of this target rate is essentially should be high enough in order to ensure enough loss absorption capacity. We aim to target to calibrate at a rate which is unique across euro area countries, so we do not go into country-specific calibrations. And also, as I said, we want to allow some flexibility to incorporate policymaker preferences, so we provide a range of buffers rather than one single rate. And then we have the calibration, the build-up rule, which is govern the speed at which the CCYB is built up and the target rate is reached, and also when it's released. So the build-up rule is just an illustrative example. It's not really the focus of the paper, but we do provide some illustrative example to reflect our thinking on how this should look like. So how do we do that? So the calibration rule is fairly in line with the one that we have proposed for the CCYB to address cyclical systemic risk. In particular, we take the coefficients associated to the time fixed effects, those that are negative and statistically significant, and we normalize then again by average risk-weighted assets in order to have the units expressed in units of CCYB, and we take the average across the years included in the model, in the sample, sorry. Here there are two discretionary choices to be made. So first, we have to decide, obviously, which percentile we have to focus on. So as I said, we can choose any percentile of the conditional distribution. So here we focus on the 25th and the 10th percentile, with the main idea to essentially put our focus on the left side of the distribution. So we want to be below the median, but we want to avoid the really extreme tails for two reasons. First, because again, in the effort to minimize overlap with other instruments. So in particular, we want to minimize the overlap with P2G, which tend to cover losses that comes from very extreme scenarios, and also more from a technical point of view. In the very extreme tails, we tend to have a high data sparsity, and so this obviously decreases massively the precision of the estimates. So we want to avoid to have less precise estimates. So in terms of horizon selection, because we have a local projection framework, so the estimates comes at different horizons. we focus on 1 year ahead. This is just to account for the implementation lag of the CCYB. Okay, so why does this approach make sense to us? So the main desirable feature of the time fixed effect coefficient is that it's invariant across banks as opposed to be bank specific. And this aligns with the goal of capturing essentially an observed factor that simultaneously affect all the banks in each period and that are not otherwise accounted for in the regression. So this, we think that is consistent with the positive neutral CCYB, which is a macroprudential instrument, so hence is essentially set to address systemic rather than bank-specific risks. And also which aims, as I said, if we recall at the beginning of the presentation, the main goals for the positive neutral CCYB, it essentially aims to cover those losses which are uncovered by other capital buffers because we want to minimize obviously overlap, and that essentially stem from either risks that are like going beyond those that stem from cyclical systemic risk, because this is already covered by the cyclical CCYB, or because they stem from the essentially uncertainty in measuring cyclical systemic risk. So the results of the calibration. So here, for completeness, I also show the results with the 50th percentile, but as I said, we focus on the 25th and the 10th. So essentially, if we take a more conservative approach and we cover losses stemming from the 10th percentile, then the model delivers a calibration of 1.8%, while with the 25th percentile focus, the model covers essentially, the model delivers a calibration of 1%. So this is the example of the stylized build-up rule. So what we have in mind here is that the build-up should also, I mean, as has been discussed in the previous presentation, we want to minimize the overall cost of the increase in capital requirements. And in order to do that, we set a build-up rule which says that essentially we increase the CCYB in times where banking conditions are favorable, meaning that we have a high profitability with a low dispersion in this profitability and a low financial distress, while the release happens on the other way around when we have negative profitability and high financial distress. If we implement this calibration rule and this build-up rule, we can obtain then essentially a joint calibration for the CCYB through the cycle. And in order to do this joint calibration, what we do is essentially after calibrating the positive neutral CCYB, we re-estimate the model in order to deliver new levels of cyclical CCYB, because we want to take into account the fact that in the banking system, now we have also a higher level of capitalization. And as I said at the beginning, we consider that when cyclical systemic risk hits, having a higher level of capitalization essentially can provide some, can mitigate those effects. And so we want to essentially include this and take this into account when we calibrate the CCYB to address cyclical systemic risk. So we perform this joint calibration by re-estimating the model, including the PNR in the system. So what we obtain with this joint calibration. So here again, there are just 4 examples of the countries that we have in the sample. So first of all, the main insights from this joint calibration, thank you. So is that first of all, we have a more, especially in the post-sovereign debt crisis, we have a more gradual increase in the CCYB compared to if we had only thanks to the PNR, if we had only the CCYB to address cyclical systemic risk. Moreover, and most importantly, if in the years essentially before the pandemic, in most of the countries in the sample, we would have had positive levels of CCYB overall. So we perform a number of robustness checks, with alternative specifications of the model. We tried also including or not including the significant or not significant coefficients for the calibration. We also tried different interaction terms or other macro variables, and the results seems to be robust to all those checks. Let me conclude. So this paper proposed a novel framework for the calibration of the overall CCYB through the cycle. And our approach allows to disentangle losses associated with financial cycle from those not related necessarily to the financial cycle. And this framework provides an harmonized calibration of the positive neutral rate while also accounting for country-specific conditions. And finally, it delivers a calibration of the overall rate while also accommodating for policymaker preferences. And with this, I'll stop here. Thank you very much.
Thank you very much, Giorgia. Again, remarkable management of time, which makes my job very, very, very easy. So let me see. Now for the comments, the floor is yours, Javier.
Thank you very much, Jesús, and also thank you very much from my side to Galo and Rafa for inviting me to discuss this paper, which is very interesting, very timely, and also deals with a topic that is very relevant for my own work at the bank. Let me see if this works. Oh, takes time, yes. Oh, not too much.
Yes.
Okay. I would like to start by putting the paper first in a historical context, what the original design of the CCYB was, and then in the context of the positive neutral CCYB, which many countries, including Spain, have already adopted. So in order to understand the contribution of the paper, I think this would be useful. The original design of the CCYB was as a reaction of the global financial crisis, and especially the boom that occurred in the years prior to the global financial crisis. It was thought that it would be useful to have a buffer that could grow in times of excessive credit growth. And this was, the credit to GDP gap was chosen as the indicator that would guide this activation. However, after the global financial crisis, some countries, in particular the Bank of England was a pioneer, started to realize that activation of the CCYB would take a lot of time. And in the meantime, some systemic shocks might occur. One of them was the COVID pandemic. So this was the origin of the movement towards the positive neutral framework. Many of the countries that have already adopted this framework now typically try to characterize cyclical systemic risk in different phases. For instance, in our case, it would be 3 phases. Low risk would be basically materialization. High risk would be the kind of events that would have triggered the activation of the CCYB in the original design, while the intermediate risk level would be basically the normal times. Normal times means that cyclical risk is not so high, but it's worth activating the buffer. How is the buffer calibrated? Well, most countries currently use a stress testing methodology. However, it is true that this methodology typically doesn't use the same models nor the same scenarios, so it's quite heterogeneous across countries. So this is where the contribution of this paper comes. And I think it's a very interesting contribution because it tries to bring some consistency across these decisions, across countries, which is clearly the way forward where we need to go. How do the authors operationalize this proposal? Well, as Giorgia has very well explained, They consider a panel of euro area banks, 318 banks. I think that the effective sample starts in 2008 and ends in 2019. And they consider quantile regressions. On the left-hand side, they have return on assets. On the right-hand side, they have different, well, three main blocks of variables. Bank variables, that I believe that they are just controls. Cyclical variables. Here, the most important variable is the systemic risk indicator, or the DSRI, because this is the indicator that they use to calibrate what they call CCYB for cyclical systemic risk. And it's, the formula is on the right. I have put in red the variables that are country specific. So that formula, the coefficient of the quantile regression is not country specific, but then some of the variables are country specific. And finally, there are fixed effects, bank and time fixed effects. Sorry, I forgot to mention that in terms of cyclical variables, there are other cyclical variables. Coming to the fixed effects, the time fixed effects are the most important ones because those are the effects that the authors use to calibrate the positive neutral CCYB. In this case, they take 2018 as the more normal year in their sample, and the calibration is basically the maximum time fixed effect compared to this year. Okay. In addition to this framework to calibrate the buffer, as Giorgia has explained, there is also a proposal, at least an illustrative proposal, for the build-up, the maintenance, and also the release of the buffer, which depends on, for instance, the build-up depends on the return on assets being in the country above the historical median. The standard deviation of this variable has to be sufficiently low, and then the level of systemic stress in the financial market should also be low. The rate at which the buffer is accumulated cannot surpass 25% of bank profits. Okay. I will give here my overall assessment, and then I would like to talk about some specific details. First, as I have mentioned, it's clearly a consistent tool, which is very important. I will talk very briefly about the econometric approach, but it's also a robust econometric approach, very interesting. The fact that there is an automatic rule is also interesting. I mean, national authorities, when they activate the CCYB, typically can deviate from rules, but rules are important because they impose some consistency in our decisions. At least we have to explain when we deviate, why we deviate. So this is very useful. On the more or less positive side, I have some comments in order to increase some the capacity of the model to adapt to national specificities. I mean, for instance, when you consider a positive neutral CCYB, it is true that many countries are now clustering around 1%, but at least the model could have more flexibility. And then, well, as I don't have much time, I will move here to my main comment. Well, my main comment is that I still consider the positive neutral CCYB as a cyclical buffer. So you calibrate what you call CCYB for cyclical systemic risk based on the systemic risk indicator. However, there are other cyclical variables that are very important, and they may capture part of the cyclical systemic risk. In contrast, the positive neutral is based on time fixed effects, which are residual, so they could be sensitive to adding more or less cyclical variables. This may be a crazy proposal, but at least I would suggest to explore these other cyclical variables in order to explore a potential alternative calibration of the CCYB. For instance, intuitively, normal times can be thought as a period in which the DSRI is not very high, but GDP is growing, sovereign spreads are not so high. This could be operationalized in a calibrating formula. However, this would require probably re-estimating the model with different variables, but it might be worth trying. In my last minute, let me see if, okay. Also, regarding the econometric approach, which I find very, very interesting, there is a literature already. I am an outsider here, but I believe that you introduce a kind of linear structure in the coefficients across quantiles, which is avoid some problems that you have mentioned. Why linear? Perhaps quadratic effect might be interesting. And also regarding the return on assets, I am not sure if you are using total consolidated profits in order to compute this. For large international banks, it may matter to consider consolidated ROE or only business in the country. However, as the CCYB is a buffer for national exposure, for domestic exposures, I think it would matter. Perhaps in Spain you wouldn't activate so early in 2015 if you consider only business in Spain. I don't know, something to consider. And well, I think I will stop here because we are running out of time. Thank you very much.
Thank you very much. We are sorry for pressing you so much. So maybe a couple of questions from the audience, please. Rafa, please. Mike is coming.
Thank you. In these exercises, the endogenous response of banks to the regulation is ignored, essentially. And I think that, so basically, the idea is let's look at the buffer effects of the regulation for a given probability distribution of losses or whatever the indicator you're having, as opposed to thinking about what kind of incentive effects this regulation may actually have. And these effects may be on the size of voluntary buffers, like you were mentioning before, on the incentives for risk-taking. I understand that this is a horribly difficult problem, but I think that, I mean, having in mind that the other side is not going to stay quiet and it will do something, and anticipating what may happen on the side of the regulators may be important. Now, the second thing is that the paper, or the papers really follow the silo approach of the Basel Committee. So you have the different types of regulations, capital, liquidity, for credit, market, operational, etc. But I think that, I mean, it would be, again, the ideal thing would be to think about the different ingredients of the regulation, not sort of looking at the interaction between the different elements of the regulation. So in the paper by Javier, you have the 5, right? And then you were playing around with these two things. I think that having a sort of a less partial silo perspective, a more holistic approach to the entire regulation would be desirable. Now, what I'm sort of proposing is sort of horribly difficult problem. And basically, the point that I would like to make is not a question. It's essentially that we need a lot more research on these topics, and we are far from sort of having to call off these type of conferences going forward, because there is a lot of stuff to be done on these and other related matters. Thank you.
Thank you very much. Another question, please. No more questions? Okay, please. Short and sharp.
Okay, I will bring something that I think is typically absent from these discussions. When we propose regulations to banks, some of these regulations are costly to banks. So a natural complement would be to reward banks for the cost we are creating with those regulations. For example, if we ask them to be particularly tight with, or not tight, loose with their capital, or should have more capital in their balance sheets, we know that capital for tax reasons is an inefficient form of finance for banks. So a natural thing would be to give a tax incentives while we are imposing those regulations, and then thinking the general equilibrium effect of those a bit more seriously. I mean, again, this is completely external to the discussion in banking typically, but in corporate finance, the natural lever of intervention would be the tax rate. So I'm not sure that the central banks can do much about the fiscal policy, but it's something to think about.
Thank you very much. If I may add a question, it's a corollary of your paper that ECB is ready to apply Article 5 of SSM regulation. Thank you. The floor is yours.
Okay, so thank you very much, Javier, for the very constructive and useful discussion. Really super appreciated, a lot of food for thoughts. Yeah, definitely the point on country specificities to be taken more into account is something we would like to definitely work on, and also, I mean, it's very important to make it more operational, obviously, because it's given the national nature of obviously of the tool. I mean, there are a lot of things that I think we want to discuss. We will do it bilaterally, and but in general, really, thanks a lot. It really provides a lot of also like really material for improving the paper. So thank you very much. So regarding the so yeah, taking into account the endogenous response of banks to regulation. So yeah, this is a very important point. The paper is. I mean, it has, the model is a reduced form model, so it's yeah, this is what, I mean, I show what the model can do, and this is something the model cannot do. So, but yeah, I mean, definitely, I mean, it would be very interesting to work on some extensions or or some type of modeling that take this into account using a similar framework. But yeah, this is, I mean, this I guess would be completely, yeah, different work. Also, yeah, very interesting the point on the interactions across different regulations and being more holistic. We try to, I mean, we try to do that in order to, I mean, we try to kind of have an holistic view in the sense that we argue that we include in the model a number of, you know, of bank variables and then country level variables. Probably on the country level side, some structural characteristics are missing. But then okay, then there will be a problem with the time fixed effects, that some information will be absorbed there. But essentially, we strive to have an holistic approach by including as much as possible in the model, because we said, okay, I mean, we want to have this residual component that we take for the positive neutral, and we try not to overlap this with any other instrument in the regulation, and we try to kind of put there all the like bank-specific characteristics or other cyclical characteristics that are used to calibrate or should influence other buffers. But this is definitely something I mean, we try to do. Yeah, finally, on the, yeah, in terms of rewarding, like, actually one thing that made me think your comment is that one aspect that is important is also to take into account the cost of implementing those requirements, and also there, like, it's something that we have thought a lot about to include in the model, to include in the paper, sorry, but I mean, so far, I mean, also there we think that it's probably going to be completely different work, because it's like really not in the focus on the paper, but it's definitely something that it's worth. I mean, it's an aspect that is worth exploring and worth studying. I mean, in the paper, we just essentially try to see how much the buffer should be to cover certain amount of losses, because then this would translate in capital depletion. But actually, we neglect the cost of increasing. I mean, the only part of the paper where we take into account the cost of increasing requirements is essentially when we have this stylized build-up rule, and we try to see, like, to make it dependent on bank profitability in order to minimize the cost, because this has been shown largely in the literature that like costs of increasing capital requirements are largely nonlinear in the bank profitability in bank conditions, banking sector conditions. But it's something that we do not dig too much deeper into it. But yeah, and then, yeah, I mean, the paper, I don't know whether that would be a corollary, because, I mean, it has obviously some limitation in what it's really focused on, yeah, like the amount of losses that should cover certain specific, the amount of buffers that should cover like certain specific losses, and I think that would be a bit maybe ambitious for the paper to say that would be a corollary. So maybe I will stop there. Thank you.
Thank you very much. I think that thank you very much, discussants and the audience and the authors. We move immediately to the next section. Thank you very much.